Okay, um, good morning, everyone. Okay, my name is Adeniyi Saheed Olalekan, and I'm a market strategist at Swahili Markets. So basically, what we're doing now is doing our outlook on some currency pairs for this week. We have started already, but just wanted to know what our projections are for the week for some markets. So let me go straight answer to to the chat. And besides, if you don't have an account yet, you can open an account at Trade, um, and you can actually reach out to us to our market that we do investments big scale and we recognize the way around and look forward to see you. So let's get into the analysis. See what we've got. Then this out. So the first pair we'll be dealing with is GPUSD, the popular shares still analyzed in the market. We've done an analysis already, so we're gonna actually explain how we get about the analysis and what's our projections. Do you want to sell, buy, probably stagnant? So this is complete analysis and you know something about forex. Wasn't 100% sure, but it's very strong analytical skill, and proper risk management. We can at least be sure of our markets and what we've got. So looking through GPB USD, I'll start by talking about structure. So let's see what's the structure of the market right now. We look closely at the structure of the market. The market basically has been in a downtrend. Yeah, so it has been a downtrend for some while now, and now it's trying to change. I can actually watch closely on the note there. Has been a very good uptrend during this corona virus everything. So after the pandemic, but at least reduced to an extent, we see a new trend in the market. So this is an uptrend, so to say, very momentum to the upside, bullish momentum. So after that bullish momentum, we've not seen any strong bullish momentum that actually that's convincing to talk about. So let's start. We are saying this is our last low. This is our last low over here, upside. Okay, cool. Then let's see what happens. Then we form a new high. And we're saying by the way of market structure, we want to know if there's a bit of structure yet or not. This is our new high, and this is our new low. This area. So we want to see the new high. Let's see our high. This is higher high. So we expect if the market is an option, we're expecting to see an higher low, then a consequential higher high again. But let's see into this market. Obviously, we, what we see after this high, not seeing that new high. You can see after this high forms, there was a low. Actually, very strong higher low. But the high that came after it could not go beyond this resistance level up there. Let's go up there. Yeah. So that's telling us that the market has not been structured yet at first in that place. So we're still in the market is an uptrend. So I have to see a bit of structure if we can see. Let's think about that. So let's see what happens. So after forming this high that makes this, so we're expecting that the market retraces back to maybe like some percent, maybe 60%. So what is Fibonacci retracement? We're expecting the market to retrace back to that kind of level and just to pull up. But the market has still been in the bull market. You understand, like particularly in the bullish momentum. So after some while, the market came up there. We tested this resistance and not break it. So came down. So that the forming is same thing. the very strong, very momentum was coming so heavily and fast. So there were noises, and the way, but the original sale was actually obvious. You can see how bearish, how fast bearish, part of the market actually looks and where it's triggers it. So that being said, we we can actually observe something because if this is our higher low, I mean the low we got from the maybe which was the first low, got a higher low and new higher low. We are seeing an uptrend. So if I can actually see the market actually broken structure, we want to see this low, this highest, the highest low right now get broken and what happens there. And market got it broke the structure because it broke this higher low. So we understand something. In uptrend, we want to see higher highs and higher lows. Now, right now, our higher low has been broken to form a new low. Understand? Understand? So that's a break of structure. So that's why they're saying, okay, if there's a break of structure, then we are expecting a retracement back to a level, maybe uh, Fibonacci should look like 70%, 70%, all the standard areas where we understand that market can actually reverse. That's what you're saying. That's why you see our results from here. So we didn't actually decide that it was Fibonacci. We have other conferences that give us the um, go ahead and say, okay, this should actually retrace from there. Oh, sorry, reject, and give us a sell market from this sell zone. So I'm gonna explain how I get that. Basically, I use traditional method of trading. I want to see mitigations. I want to see imbalances. I want to see pullbacks. So those are the things that I actually use. So let's get into this level first. We start from very, very far behind. We're going to see that a kind of imbalance in this area. So there's a kind of imbalance there that we're going to feel. Imbalance is just like a bullish momentum without any bear. It's very proper for for markets to just go bullish without any bear. Doesn't make sense. So it has to be balanced. So that's why it's market come to this kind of area and just balance this empty, pool. In lower time, in very high times, so this will actually come across as a gap. And so whenever you see a gap or imbalance, it has to be filled. You have to understand that you're not filled immediately. It might take time to fill, but it's going to eventually fill the imbalance. So that's why I mark this imbalance out. And you can observe very closely that this market actually filled the imbalance. So this is how those get to if the imbalance has been filled. Imbalance can be filled in plenty of ways. So the first way is each whenever market feels just imbalance, that's fill it. So you can actually come back there again. So that's why we actually mark this point out. We look closely here that those are imbalance. So that's our imbalance. We're looking for 50% of the imbalance to be filled, and this percent of the imbalance around there, which has been what has been actually be filled. We look closely to the alternative of the front side, you're going to see the imbalance filled to 50%. So we're not expecting the market to come back there to total the field. We're expecting that move. Understand? If we're actually we actually lucky, we have actually said, let me calculate the imbalance directly so that we can actually know what it costs. And this is how we did not take because we're in the markets. Let's calculate the imbalance in this area. So this is how you calculate imbalance and know where you enter your market or set your market. So you just take a Fibonacci. Because Fibonacci actually help to at the conference to actually confirm all these things. So once 50% of this imbalance, once percent is filled, you move down to 50% of the imbalance has been filled. This trading view, if you don't know, use 24 trading view on the best, to analyze markets. It's actually very cool to enjoy what you do. So you are taking this imbalance here. We're expecting markets to fill 50% of this imbalance. You understand that? So let's take this to 30%. So like me as a person, I think 50% is 61%. This is because like where I actually went from. that's how I perceive it. He said taking 50% percent actually all depends because markets always falling within 61% and 50%. So I'm just going to put 50%. Let's just put it that so that confused people out. So we expect markets comes to trade this line back, before uh, start. So that is that. That was how we caught the imbalance that area, and that's that. Let me put it out. The jumper. So that is said, then okay, let's move to new parts of the market. So we found out that the capital has broken structure because this was the highest low they had in the market. So this highest low has been broken by by this kind of initiative. It broke down to this extent. And so when it broke there, so we're expecting that the markets uh, comes back to Thursday and come back down. See, this imbalance that hasn't been filled there yet. These people are, you mark something out the other time that hasn't been filled yet. Market is not back to the imbalance. So that's one of the drive that makes us feel market is going to actually sell. That is one. This is a confidence. Market is coming to feel the imbalance. One and two, there's a bit of structure at the same time. So those are the two confidence we have right now. So and aside that, we have some other conferences. We have money here, we have liquidity here. Well, people that actually entered buy market are putting their stop loss around this area. We have liquidity here. So market is going to come and pick out the liquidity. That's one short thing. Bankers are coming to pick up all this money, all this stop loss. A lot of retail traders actually set here. So that's what happens. And this liquidity has been taken out already. We expect market actually goes up because it has to test to at least 71% of Fibonacci. That is what I use. But the thing is this: we don't just think it should test back some function of Fibonacci. We use what we call order blocks. You can see very closely here. This is a double top, and this double top was taken out by this bull can be strong value. So we expect the market to not actually want to come here and make people um, leave the market with to be at break even. What I'm saying is, what happens is there is liquidity here. We have a lot of sellers, people that are sold to market here, and those people will be setting their stop loss here, obviously. The market came out, the bankers came to market and just took them out directly. And after taking them out, they continue moving down. Can you observe this closely? They continue to move down, it's down. So that's what we have. So we expecting that the bankers will not come close to this area again because the new sellers that are there that set the stop loss very sorry, I say buyers, let me get this something here. Sellers are here, you understand it. We took this time to take all the sellers because people setting their stop loss here. And one thing about retail traders is this: they believe if the market goes against them, so it should trigger another buy stop there. So some people will be in buy already. You understand? Some people in buy already in this market. They already you said the buy stop. They said that the market breaks and doing profits. The man knew market knew what they were doing. Markets were what they were doing. So buyers from here are going to be buying and it's actually a big loss for them. So imagine markets coming back to that area. That means anybody that actually enters buy that doesn't set stop loss he is lucky, very lucky. Market will get back here and he's going to break through. Like, wow, thank God, market go back here. I don't even need profit. I just want to break manage the market. So backers will not allow that to happen. And at the same time, this bull can market actually set out here and start. It's a lot for them. You understand? They sacrifice so much money to make this bull market come up. So they just want to break even and just leave the market and just continue the market in the right direction. But they knew during the way, during their way coming down again, they were taking a lot of liquidity out, they were taking people out and take their money very long. So this should be enough for them, to what the risk of risking this amount for this to happen. You understand? So let me give you what happens here. So let's say even people okay after the market came back to normal, so selling like we projected here who enter the market in this area and they set their stop loss above it. So can you see this week takes them out, even who sell they want market to come to this area and take their profit, take them out here, so on and so on. So we just want to make sure we know where the bankers are coming in and when they're supposed to mitigate the market. So we expect markets to bankers come and mitigate the market around this zone. That's why I said sell zone. So you can sell at any point in this area. So the thing is, the market might actually come and mitigate there alone, just come down. It might come, it might decide to just take percent of the worth of the the candle that they actually used to just take percent and just move that. So we have a decision to themselves. But what we're very sure is that if this break of structure is actually true, that means there's a break of structure from an uptrend to a downtrend. So we're expecting to retrace down to this or up to this sell zone, then it actually come down to sell. So that's why we actually gave our verdict on it. So we have conferences where we actually expect this to happen. This mitigation is going to happen year one, and we know that okay, for some market, there are a lot of liquidity here that markets will want to take out liquidity here, liquidity here, liquidity here. They want to take all this liquidity out. They want to make money from retailers' money. So that's what we're doing. That's what we actually are projecting our market on. So from there, the market to sell to this level, then sorry, if you buy to this level, then sell down. So once the market gets to this area, you can actually set your sell limit. You can set an alert. That's why trading is very, very cool. You can set your alert here. Once you set your alert here, you're good. To just alert you on market get to that level so you can actually, enter your sell market. This is your risk. Yeah. This is your risk. This is where your stake is to be. So let's see how much you're risking for, for the profit. So if market triggers here, once you're risking 138 pips, so you're not actually risking 138 pips. That is too much of a risk. But it's simple. Even if you have very high stop loss, risk management is actually key. You don't need to use. You want to risk 13.8 pips. Can you use 0.01? Yeah. Let me show you the reward on this market. Let me show you on this market. Let's go. It's going to come down to this level. Let's these are take profit zone. So let's put it around this area. So you're risking $138 for $526. That is what it is. So we are saying what I'm not saying you should set it cost $1 we are using 0.1. That's mean if you are using 0.1, you have to do account to actually risk. So you can use 0.1, you can use $13 for $52. Oh yeah, $13 for $52. It's something cool. But then now, further lecture, actually explain to you how we do a sniper entry such that you'll be risking so much of your money. You get to the market at the right point, and when you get there, you can actually minimize the risk. Then this is at least worth it because my first because you have to risk. Just say you just really don't want to risk and you want to make money. Nobody does that. Nobody does that. You're gonna risk some amount of your money to make some profits. Can you see what you're risking? You're risking like this is one ratio 4, 5, so to say. 10 times 5, so kind of 1 ratio 4 point something. So that's big. That's big for you. So one market gets so we're actually waiting, we don't want to rush into the market. One market gets to this sell zone and show what's going to sell really. Because we're gonna actually sell because of those confidence we have. And what our confidence is integration area here, they're gonna mitigate this buy position. That's one. And two, there is an imbalance down that they are trying to fulfill. And the third one is this there's a breaking structure from an uptrend. So if they're breaking structure from an uptrend, they are expecting downtrend market to actually come up. So this is our sell zone, expect market to sell from here. And this is our profit ratio. And how do we set our profit ratio? We won't just pick an area and just set the profit ratio. You understand? This we actually go back to the previous market. So I put to around this area. This is our imbalance is. We want to make sure it's fit imbalance. We didn't actually take profit alone based on imbalance. We use our Fibonacci to check. Then we use our Fibonacci. And our take profit was around the 2.17 something that we use for our take profit. Yeah. So people around 27.17. Fibonacci. That is how we set our take profits. So the market is going to respect it. That's very sure. So that's that about that. So let's check the other market. Since the market is already on the other market will actually actually going to talk about is uh, this is the GPU. If you want to check the other market, that's where to take it right. That's one of them, I guess. Where to take it right. USD JPY. Okay, okay, okay. Wow, the market is moving already. So this is serious. This is so exact same thing that that happened that we explained with the with the GPU. This would happen. The first thing I told you structure is what I do. I actually try to get market structure first to actually decide what's going to happen in the market, and then I look for mitigations area, mitigation performance, and decide based on that. So let's see the structure of the market. You see the low is a high, is a higher low, a higher high. So we're expecting the higher high is a higher low. We're expecting markets to actually boom and just go up from here, from the beginning. But we didn't actually stuff like that. So this eye is still the same eye that we're seeing, and this was this our last day. It wasn't a new low. Understand? So we're expecting the market still back because it has not broken structure yet. So this can these are low, this higher low, this higher high. So you want to see a higher low, could you actually see here? And you've seen the higher low and but since this could not actually break the low here, so there's no bit of structure. So the same market is going to actually buy like the red. So what are our confidence reasons why we want to actually buy the market? First and first, let's look into the previous market. Can you see there's an imbalance around this area? The market is going to feel the imbalance. Imbalance around this area. The market is going to feel the imbalance. Understand? At least 60% of the imbalance is filled by the market. So this is what we're talking about there. So, so that's okay. So that is one of the conference of the news why we want to actually buy the market. We want to see market moving to one direction based on some things, and that's one of our conferences. Let me take that out. Don't want this to jump up. So that's the case. So our other conferences are there. So we observe closely where you have double, triple tops. Whenever I say triple top in the market, that means there's something there. A lot of people are putting their stop loss there. The bankers know very well what is happening, and they want to make sure the traders lose their money. So they want to take this out, they want to take this out. So one thing to figure out, they can actually make it for target because this is still an uptrend. So we are expecting an uptrend. So which of the candles actually took out this liquidity? So this long candle, they call it sell to buy, or they call it FE candle. They call it 40 candle. That's what bankers use instead of FE candle. You know what they call it FE because this candle took out all this. So everybody that said that I entered the buy market area and said the stop loss here, they were taken out from it. Because market is very big. It's a 4-hour candle. It's a big candle, like 20, 30 picture or more than that. Let me check the percent of it. Yeah. Okay, the candle is almost at 5 pips. So most people in the market say they are probably similar than I. The need is the double, the triple bottom. So we're expecting markets to actually not actually come there again, but markets came in and took them out. So we expect markets to come back in this area and mitigate. See, when they are doing this FE candle, when they form it, they're actually risking some amount of their money. They're in loss. You understand? So they come and mitigate. And most of the time they mitigate at this entry point or that's why I put stuff at 50%, but in 50%. So I actually enter market at this entry point. So if you can actually reach your money, that's why we used to go to enter at the early point of the market actually mitigate because most of the time bankers will mitigate at the opening of the FE candle, you understand? And sometimes they come 50% of it. Don't just damage, it might come down early, you can just for they might you might not even come back at the same time because these are happen in the market, this is market. But what we are saying in essence is we have to observe closely which of the candle takes out the liquidity. This is the liquidity here. Where people say their stop loss, that's what they call liquidity. Where they see a lot of people say their stop loss there. We just brought this candle up. This bearish is long, bearish can take all of them out. All the stop losses here from the buy. I took everything out. So they don't want to come back here directly because they knew if they should come back, people that that sold market that sold market and they see the support they will really market on the so they took buyers out and they make sure they trap in the sellers. If you sell from here and market start going there, you'll be like, wow. When you see markets coming back to this area, you'll be happy that market might actually come back. Some people actually start to take their loss immediately. You understand? But most people not take their loss there. Most people actually start selling it. The market has actually changed direction. So that's why you see the markets come to this area. And sometimes they will have come to this area. Maybe they feel there are a lot of people that still enter sellers. So if they're line to break even, they will not be making money. And they want to make money on everybody that comes to the market. They're taking money out of people that actually entered by the fair markets are not going to buy them. That's why they're sold and they're going to be trapped by bankers. So that's why they come and mitigate just entry point of the candle or probably 50%. So they will take 50 entry points. Like I see markets is going up now. This is actually buying. So expecting markets to actually buy to this feed level there on our profit targets. Because markets in an uptrend and expecting markets to go to the direction of the market. So we're expecting markets to actually go in our favor. So market is already, let's see how much people market has moved already from the open of the candle. We actually said that open here. It has moved almost 20 pips. That's huge. That's 20 pips. That's money for you. Something. So let's see the risk on this trade and the reward we have on this trade. Let's see the risk and reward. So the risk on this trade basically, let's check. If the entry market from here, the risk is 21 pips. If the entry market from here, the risk on the trade is 40 pips. You understand? So let's check the reward. Let's say entry from there. The reward on the trade is around 87 pips. That's the entry from from the open. And the entry from 50% the reward is around 5 pips. So that is at least one ratio, one ratio two is to reward, which is very, very cool and it's very open market. So for now, these are the two markets I've actually worked on, and I'm expecting markets to actually obey this guide. And in the next tutorial or video, we're going to actually explain the other markets we actually analyze for the week as to get back to our base and do some serious work. Thank you, viewers. So you can actually get to subscribe to our Telegram channel, Swahili Markets Capital. Thank you.